Ananda Bhoumik of India Ratings and of course Mr. Ram Sangapure, the Executive Director of PNB. Gentlemen, good morning and welcome. Mr. Sangapure, the problem or the doubts of the market have risen because of the refinanced assets. Now we have to look at bad loans as NPLs, restructured and refinanced. Restructured may get phased out, but refinanced is increasing. What is the total amount of refinanced loans on your radar for PNB? And how much have you already done? How much are you likely to do before this quarter is out?
Yeah, so far as a refinance or a strategic restructuring is concerned, I think we have done so far accounts worth 2,500 crores. And in the next quarter, we visualize somewhere around 3,000 crores of rupees worth we will be going for.
Okay, not 10,000 crores, because I thought in the analyst meet there was a number of 10 to 11,000 crores guidance.
No, not for the next quarter. Definitely okay. Not 10 to 11,000 crores.
Okay. Now, in this 5,500 crores, where you have clarity, 2,500 done and 3,000 to be done, what is the sectoral distribution? How much is power? How much is steel?
Most of it is from a steel, actually.
None at all from power?
Power, most of the power, maybe about 30% you can take.
Okay. Yeah. I just want to get Ananda into that. Yeah. Ananda, you know, if 30% is power and 70% is steel, how are you all looking at refinance loans? Will you all now start adding it into stress, lock, stock and barrel?
Yes, so the approach we're going to take, and we'll probably publish shortly, is we're going account by account on the steel and power infra, and we are trying to get a sense of, even at assuming peak capacity down the line, say in 3 or 5 years, is the debt level sustainable? And our early sense is it probably is not. For various reasons, cost escalation, delays, these projects have just taken on too much debt. And possibly even at peak utilization, you may need to shave some of the principal off. So I think down the road, bankers are probably staring at some amount of principal haircut. So we're trying to put a number, and we probably, as I said, get a definitive sense shortly.
Okay, but qualitatively, Ananda, do you think there is any moderation in the bad loan formation of the PSU bank, sector as a whole, or because of higher refinancing, you would still continue to be worried?
I think the environment is, in terms of accretion, is roughly the same as what we had seen earlier this year. So there is really no new surprises. What has obviously caught everybody by surprise is the fact that the pickup hasn't been as robust, as a result of which some of the assets we were hoping would come back on stream will take more time. So FY16 is going to be a bit of a washout as far as recovery is concerned. So in terms of incremental slippages, yeah, probably not too many surprises. But the concern, I think, is going to shift to what is the appropriate level of provisioning for some of these refinancing and restructured assets. Is it okay to go by a nominal 5%? Or should we really take a higher number? I think that's what we hope to have some clarity.
But I don't think the rules require even higher provisioning, do they, Mr. Sangapure?
No.
No, I don't think there are any additional incremental provisioning per se. And banks are following the guidelines from Reserve Bank of India. No bank can, violate the guidelines from Reserve Bank of India. So, from a perspective of provisioning, I think nobody should have any worry on that account. The question is how far it will take for a revival of the economy, and how far we would be able to sustain this kind of adjustments. That's a big question.
Okay. Actually, Ananda, it's a little dangerous that refinancing has no extra provisioning at all. At least restructured loans had that 5% extra provisioning. But how will you treat to come back to the same question, this refinancing loans? In the restructured loans, what we saw over the last 3 years is that about 30% became NPLs. The remaining recovered. So when you look at the refinance loans, for instance, this 5,500 of PNB, how much will you treat as impaired or stressed? Will it be
We'll
good? Yeah, will it be good to believe that power? For instance, we know that a company like Tata Power went for 525. Tata Power was never not going to pay back its loans. It was not a stressed loan at all. But still, practically, half of them will never be able to pay back their loans if they were not refinanced. So, will you make a category like everything steel is impaired? How will you take 50% of the refinanced loans is bad loans? How will you calculate them?
We won't generalize. We're going account by account for the 40 largest, and our sense is about a 20 to 30, depending upon the account, a 20 to 30% provisioning is probably appropriate. I think the PNB is right. There is no regulatory requirement. We're not talking of the next quarter's requirement. We're talking of down the road. We're talking of an economic value of those assets rather than an accounting value.
Okay. Mr. Sangapure, this time around your slippages have fallen significantly to 2,800 crores versus about 7,400 crores earlier. Can you give us some color on whether your slippages will continue to fall, and your own view on whether we are seeing lower bad loan formation and whether that is sustainable going ahead?
Yeah, so far as slippages are concerned, I believe going forward our incremental slippages will come down. It may not come down substantially, but definitely a downward trend has started. And that doesn't mean that the gross NPA ratio will drastically fall down, because there are other factors which we have to take into account, but that the growth in credit itself is not that very encouraging. It's still in single digit. So I think the percentage of a gross NPA to gross advances may remain more or less in the same range, maybe 10 bips lower or 10 bips higher. But I believe for financial year 2016, I think the level of gross NPAs may not exceed what we have seen now.
Okay. Ananda, by when will these refinanced loans simply become NPLs? Do you see that happening in this financial year itself? You said that haircuts are inevitable because even at these levels, refinanced levels, they will not be able to sustain their debt. So when do those skeletons pop out of the cupboard?
I think it depends upon the level of restructuring. With deep restructuring done now, they may take a while. But the fact remains that even post-restructuring, the interest cover numbers are going to be weak. And that would continue to reflect on their credit rating. So it's a call that banks would have to take. Do they ignore the reality of the underlying financials, or do they look at the repayment period and just plod along? Our sense is it'll probably be prudent, capital numbers permitting and government support permitting, to take a prudential call.
Okay. Finally, Mr. Sangapure, X of steel and power, would you say that there is some improvement in the pace of bad loan formation, say either because government money is coming or orders are picking up or whatever, in the SME, MSME, other segments, any slowdown in the decay?
Yeah, I think incremental slippages will come down in other sectors definitely. Okay. And I believe that the reform agenda which government is going forward with, even in infrastructure also, I believe third and fourth quarter will see a little more improvement. And from that perspective, I believe for the next 2 quarters will be a little painful. But going forward after that, I think banking industry may do much better.
All right, we'll leave it at that, gentlemen. Thank you very much for joining us with that discussion, Mr. Sangapure and Ananda Bhoumik. We just had Thermax telling us that they are not seeing any orders picking up, so yes, the banks are still living in hope.
But at least the fact that, by the end of FY16, the NPAs will not be much worse than what it is currently.
That's only because you're defining them differently.
Okay, perhaps.
You're not defining the big bad guys as NPLs. So okay. I'm not terribly convinced from the numbers that, actual bad loans correctly defined are going down.
All right, well, that caution continues. We'll take a break though. Up next, losses have narrowed for